We have been talking about lines of credit and Xavier's purchase of supplies for his new detailing business. But there's another liability we should consider with this new part of his business. Xavier is going to be collecting subscription payments for his detailing work. This means he will have some deferred revenue. Based on Xavier's terms, the services will be used within 1 year, making it a current liability. It's a liability because there's always a possibility that the buyer might cancel the order or the work might not otherwise get carried out. Look, just because that money is in your bank account doesn't mean your client won't ask you for a refund in the future. People are unpredictable. Since deferred revenues are not considered revenue until they are earned, they are not reported on the income statement. Instead, they are reported on the balance statement as a liability. As the income is earned, the liability is decreased and recognized as income. Look at this example of when Xavier collects a $1,000 payment for detailing services over the year that have not yet been performed. Remember the normal credit balance that current liabilities have? When Xavier receives the money, he debits it to the cash account because the amount of cash his business has increased. And he credits his deferred revenue account because the amount of deferred revenue is increasing. As he performs his services, parts of the deferred revenue become earned revenue. So, if he details for a client once per month, the amount of money equal to the monthly service becomes earned revenue after he performs the service each month. Whew, do you think you have all that? Let's take it one step further. You know, I like to push you a bit. Sometimes you have to push yourself a little. You are capable of more than you know. Usually. Mostly. The other day, I did a cartwheel thinking it was like riding a bike. It's not. Let's say Xavier sells a detailing package at the beginning of the quarter to Amanda for $300. Because he hasn't earned any of that revenue yet, he records Amanda's $300 payment as deferred revenue using the following journal entry. Because the subscription entitles Amanda to 3 months of detailing, he decides to recognize $100 of the deferred revenue every month. 300 divided by 3. Let's say he sold Amanda the pack on January 1st. That means he would make the following journal entry on January 31st to decrease the deferred revenue liability by $100 and increase membership revenue by $100. He would continue to recognize $100 of the revenue at the end of every month until the deferred revenue account reaches zero, at which point the full $300 would be recorded as earned revenue on his income statement.